What's up, guys? Your boy Mr. Fit to Flourish, and today I wanted to talk about the 4 phases of a market cycle. And this can be depicted by auction market theory, right? Let's get right into it. So first of all, we need to know what is auction market theory. So auction market theory is basically a framework that governs how assets or equity prices respond to market events. So what the heck does that mean, real? What the heck? So basically, things are going to trade at a fair value until an event happens that causes price to go up or to go down. Okay. And you'll see that a lot with like earnings. So we'll see like something's like trading like sideways for a while, and then there's earnings and they're like, oh, we're creating this new AI that's going to change the world. And then the stock goes way, way up because people are like, oh, snap, I need to buy, I need to buy, I need to buy. And that causes a lot of buying pressure. Or you'll see something's trading sideways and then they're like, oh, we're not doing good on sales. Sales are down and they're going to be down next year. Then after all that sideways movement, you're going to see that stock go all the way down. Okay, so there's always going to be a catalyst for an upward movement or a downward movement, and until there is, you're going to see things trade at a fair price. Okay, and that goes for anything like commodities, like food, shoes, clothes, like all that good stuff. All right. So it's all about supply and demand, but basically price trades at a fair value, which is agreed upon by buyers and sellers as optimal. Okay, that's supply and demand, and then you have market events like again earnings, reports, news, unexpected incidents that impact prices significantly. All right, and then in imbalanced markets, prices move directionally in search of new buyers or sellers. So you know that there's something called order imbalance when price is shooting way up or shooting way down. Okay, that's not balanced. It's just boom, boom in one direction. A balanced market is when price is just moving sideways, right? So prices eventually reestablish fair value and repeat the cycle, while balanced markets see prices closely aligned with a fair value. Okay, so let's actually take a look at what that actually kind of can look like. Okay. So auction market theory can be explained by the 4 stages of the market cycle. Okay. So what does that look like? It looks like accumulation, which is basically when we're just trading sideways at this low for a while, and then the markup phase. So the markup phase happens after a big event happens, like, oh, we have this new AI that's going to make us $1 million. Everyone's like, oh, I want to buy the stock. So we get the price starting to rise. Okay. And then we get to this high point where it's like, oh man, this seems like it's there's resistance up here. This price is kind of high, so price starts to go sideways again, and then all of a sudden we get another event saying like, oh well, it looks like the AI didn't make us as much money as we thought, and then it starts to sell off, which is the markdown phase. All right, the markdown phase. So you have the accumulation phase, the run up phase or markup phase, and then you have distribution, and then you have the markdown phase. Markdown phase. Now, I wanted to show you on the charts, what does it look like and how can you tell when something is accumulation or distribution? All right. So we're going to go with a very good example here on NVIDIA Schmidia. I'm going to share this tab here. This is actually a very good example here. All right. So we get this sideways movement for quite a while. And then the way that you could tell that we're going to get that markup or that run up is when we take out a previous high. So this is our previous high here. Once we break above that, you can pretty much enter to go long. You can enter on calls. Okay. So it looks like we had this accumulation phase. Accumulation. And then we had this big run up phase here. Run up, and then all of a sudden we had this small distribution phase, which is where we got to highs, and we're like, this is too high, prices are too high. And then we had this markdown phase. Okay, or sell off. All right. So how do you know the difference between accumulation and distribution? Because sometimes you can get like, you can get accumulation here, and then you get a and then you get a run up, and then you get more accumulation, and then you run up again. Okay, that can happen sometimes. Or you can get distribution, sell off, more distribution, and then sell off. Okay, distribution is basically like, okay, it's right before a sell off. Accumulation is, okay, I'm going sideways before a move up. How do you know the difference though? So you have to use something called momentum indicators. All right. So how do you know if it's accumulation? Well, if we're going sideways and then we're getting an increase in volume or an increase in a momentum indicator, you're probably going to get a run-up phase. So it's probably accumulation. All right. So in this case, I use the volume RSI. Okay. So this is called the volume RSI indicator. All right. So on this volume RSI indicator, it's showing that we're getting increased volume, upward volume, and then just big volume all around. And then you can see here with distribution, we start to get lower highs on this on the volume RSI. Okay, this volume RSI starts to come down. So if the volume RSI is showing that we're getting decreased volume, then most likely it's going to be distribution, which means that after distribution, we know that we get a sell-off. Okay, so then we get that sell-off phase. But that's basically the 4 phases of a market cycle. And that's how you tell if it's going to be distribution or accumulation. This is really like $10,000 worth of information all in like this little 5-minute video. So I'm telling you, nobody talks about this stuff that I talk about on YouTube. Everybody just pretends it's all secrets and you have to join a bajillion $1 million Discord. But I'm putting it right here on YouTube for you guys. So hopefully you learned something today. Hopefully you appreciate it. Because I'm telling you right now, that's it. That's all it is. There's no like secrets in stocks and like, oh, you have to know this. No, it's all plain and simple for everyone to see. But people try to confuse you so that they can get that edge over you because this is a 0-sum game. Anyways, it's your boy, Mr. Fit to Flourish. Hopefully you learned something today, and I'm outie. Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and growth.